description, or you can also check out the top right here on the screen. So now, to make an iron condor, you first go above the current price and you want to sell a call option. Then below the current market price, you want to sell a put option. Now, if you don't already own at least 100 shares of the stock or have the money to safely buy it, this would be a very risky strategy in and of itself. Currently, these are naked options. When you sell a call, when you sell a put, these are two options that are open and have a lot of risk. So to complete the iron condor and add protection, we're going to buy a call above the call that you sold, and then we're going to buy a put option below the put option that you sold. If you're familiar with a credit spread, you can easily see how this is just two credit spreads. These are two credit spreads combined. One is going to be a call credit spread above the market price, and the other is going to be a put credit spread below the market price. And all you need to know is that the objective of a call credit spread is for the stock to stay below the price of the call credit spread. So if you sold a call credit spread with a strike price of 100, you want it to be below 100. Now, for put options, it's the opposite. So when you have sold a put option at, say, 80, you want the stock to stay above 80. So with those two objections combined together, now you can see for yourself what an iron condor is. In a lot of option trading strategies, you need something to happen to the stock price in order to make a profit. But in the case of an iron condor, you don't need anything to happen. In fact, when the stock moves sideways, that's exactly when you are making money. In fact, for you to make a profit, you can actually say the stock needs to stay within the range of the strike prices that you pick, which is exactly what makes this strategy so profitable. If you can find a stock that's in sideways action, you're just moving a little bit up, a little bit down, if it's going sideways, this is the perfect strategy to use on a stock that doesn't have that much volatility. However, I will point out that the more volatility a stock has, the more premium the options iron condor will collect more money. However, you can easily find a balancing point. You can find a sweet spot where basically you can make good money without having too much risk. Because as long as you pick the right stocks and then you know when to enter, the majority of the time you're going to be profitable. Of course, unless there's some big events, unless there's a lot of volatility, unless you know what happened with Japan or some big event like a COVID or a huge earnings event, which, by the way, you can avoid it. You can avoid the earnings events. There are a few things that can make the iron condor, sour, and you can lose money. Of course, no strategy is bulletproof. But for the most part, if you listen to this video, you're going to have a step-by-step guide to understand that this is one of the most profitable strategies. Take a little bit extra work, but it's the fastest way to grow a small account. You can capitalize off that. With the regular stock investor, they're waiting for big moves in the market. But as an iron condor trader, you really don't have to worry about that. The power is in your hands. You can just lay back, relax, and if nothing happens, then you actually end up making money. So you're kind of in the reverse situation where people that are buying options, they're hoping for a move up, they're hoping for a move down. But with the iron condor, you're hoping for basically nothing. You're just kind of relaxing. So another great thing about the iron condor is that you'll know exactly how much you can lose, because once you enter the trade, you see how much you're risking. You also know exactly how much you can make, because when you sell an iron condor, you get right.
Low.
Yeah, hello.
Yes.